Hello and welcome to another episode of Darwin Investors. Yeah, I was off last weekend. Had friends and family in town. I was on vacation, and I guess it was more of a staycation because they flew into town and we were checking out things that were local. And while they were here, I developed this expensive Philadelphia Phillies habit. So you have to figure out how to pay for this. You haven't lived until you paid $14 for a beer. All right, so how are we going to pay for this Philadelphia Phillies habit? So let me go and share my screen. We'll get right into today's topics. So today I'm going to talk about just kind of an interesting stock idea. It's not without its drawbacks, trust me. There's a reason why this stock is $11 a share. Um, but it's an idea that's out there and you could possibly make some money. And then next, people want to know when the market bottom is going to be. No matter what I turn on, it's always like, when's the market bottom? Well, Tony Dwyer, he's the chief market strategist for Canaccord Genuity. He provides historical data to back up what would be like historically a statistical bottom for the stock market, and we'll get into what those bottoms are. And then next, a guy who's on our side, Joe Moglia. He's a former CEO for TD Ameritrade. He just kind of gives a little bit of advice for retail investors because that's what TD Ameritrade. That's who their core audience is retail investors. So he's on our side. So he gives a little bit of advice for the retail investor. And I'll just show a short video about that. And then last, I'll show you my current option strategy about how I intend to make a few bucks in this market. And so, yeah, let's get into this. Not too long ago, I made the obvious prediction that oil would increase as the summer months went on because that happens every year. And so my next obvious prediction is that winter will set in and it will get colder. And when that happens, a lot of these countries in Europe are going to need more natural gas. They get a large supply of their natural gas from Russia. And so somebody's going to have to pick up the slack and provide them more natural gas. And while a lot of this natural gas comes from Norway, Britain, Denmark, some of it will actually come from the United States, and we have companies that will export natural gas and capitalize on this shortage here. And then you as an investor might be able by extension to capitalize on this shortage, but it's not without its risks. I'll show you what they are here in a minute. So how reliant is Europe on Russian gas? Well, Russia supplies about 40% of Europe's natural gas, mostly by pipeline, and delivered about 155 billion cubic meters or BCMs last year. So Ukraine sends most of its gas to Austria, Italy, and Slovakia and other Eastern European states. And Germany is Europe's biggest consumer of Russian gas. And they've recently halted the certification of the Nord Stream 2 pipeline that goes through the Baltic Sea. And so they're going to rely heavily upon importing gas from Britain, Denmark, Norway, and the Netherlands. Norway's gas export is set to rise by 8% this year to 122 billion cubic meters. Now, Norway's going to have the same problem that we're going to have here in America, exporting natural gas to Europe, in that they're on a different currency. They're not part of the EU. They have kronas. And so it could be expensive for them to get Norwegian gas relative to getting something, say, Middle Eastern gas. Nevertheless, they're going to supply quite a bit, and they're set to rise by 8% this year. The United States will work to supply 15 billion cubic meters of liquefied natural gas to the European Union this year. And the U.S. plants are producing at full capacity. Analysts say additional U.S. gas into Europe would mostly come from exports directed from customers elsewhere. So we're already producing all that we can. We're trying to pump that. You're going to see that we are increasing the capacity, and a lot of that capacity is going to go to Europe. And we need it to be there by this winter so they don't freeze out there. So Europe's LNG terminals also have limited capacity for extra imports. So there's a problem on that end as well. They can only take so much from some other supplier. And so we've got some logistical issues to work through, but we've got about 5 months to do it. And I like to think that we can get a lot of it done and make sure that everybody stays warm this winter. Germany is among the countries that wants to build new LNG terminals. It plans to build 2 in just 2 years. And so Germany is building more terminals to get stuff in here. And so even if Russia was to pull out of Ukraine, and even if Vladimir Putin were to be replaced, I can't see a lot of like these European countries still remaining this reliant upon Russian natural gas. They're going to find alternative sources of energy, be it wind or solar, nuclear possibly. I know France likes nuclear energy. Germany's a little bit sour on it, but maybe they'll come around a little bit. You know, necessity will actually change your way of thinking a little bit. So maybe they'll get a little bit more like France and supply energy that way. But nevertheless, we're going to be, as the United States, we're going to be sending stuff over there, and we have some companies that are going to be sending it over there. And so the Department of Energy approves more natural gas exports, supplying more natural gas to Europe. As a matter of fact, during the first 4 months of 2022, the United States exported 74% of its liquefied natural gas to Europe, compared with an annual average of 34% last year, according to our recently released natural gas monthly and EIA estimates for April 2022. So who are our natural gas exporters? Well, one is this one here, this Cheniere. Cheniere is the one that you might notice that just kind of goes up and up. So Cheniere is a liquefied natural gas company headquartered in Houston, Texas. In February of 2016, it became the first U.S. company to export liquefied natural gas. So that would be why this company is kind of a hot commodity at the moment. Another one to consider would be this one here called Energy Transfer. Energy Transfer, natural gas transportation pipelines receive natural gas from other mainline transport pipelines, storage facilities, and gathering systems, and deliver the natural gas to industrial end users, storage facilities, utilities, and other pipelines. This would be the $11 stock that is in the advertisement on the thumbnail. So let's have a quick overview of some of their statistics here. So the ticker symbol for Cheniere is LNG for liquefied natural gas. That's Cheniere. Looks like today it's up about $3.93 a share, to be expected. Over 1 year, it's up 48%, and year to date, it is up 28%. They do not currently have a price to earnings ratio, meaning they lost money in the past year. However, they're expected to make money in the upcoming year. Their dividend is quarterly, and it's a 1.03% annual dividend yield. Let's have a look at their financials, and we'll see what the bulls and bears say about this company. So when we look at Cheniere, again on this, they're losing $14 a share. However, they are expected to have a forward price to earnings of 15.5. They have a market cap of 32.5. However, they have an enterprise value of 61.5. The enterprise value being 61 means, since this number is bigger than this number, enterprise value is the market cap plus their debt, long and short term, minus their cash on hand. So this tells me that this company has an awful lot of debt. So let's go ahead and look at their statements. They are rated a B by Schwab, however. Their second quarter earnings aren't due to be coming out until August. So Cheniere, if you look at their revenue here, they are growing at a really nice clip, 5 to 7, 7 to 9, 9 to 9, 9 to 15, and we would expect that number to go up a lot. However, the problem that we're having here with Cheniere is this operating expense this past year. Operating expense of $16.6 billion was more than the $15.8 billion in revenue that they generated. However, that is historically not an issue for them. They tend to always be a profitable company. It just appears that last year, maybe through CapEx, maybe they were like expanding pipelines, or for some reason they were spending more money last year than normal. So let's have a look at their debt and their cash on hand. So when we look at their balance sheet, and one thing I always hate is their book value stuff. It's like, oh, if the company loses everything, can you get, are their assets more than their liabilities? Well, who cares? I already lost everything. What do I care whether or not they can sell everything for more than they owe? Who cares? What I do care about though is this debt. So they have $29 billion in debt. It does seem to stay pretty steady. It's actually shrinking year over year. And a lot of this debt is long-term debt. We don't care too much about long-term debt. Like my house is long-term debt. I don't mind owning something and paying it off year over year. The problem you run into is when you have debt that's due within 12 months and you don't have the cash on hand to pay for it. Say that you've sold corporate bonds and you don't have the money to pay the dividend on those bonds, the quarterly dividend. And then that would turn you into a zombie company. We got a lot of those running around right now. We'll get into those a little bit later. Their current liabilities are $1.1 billion. These would be the ones that they would have to pay within the year. But they generate $15 billion in revenue every year, so they should be able to cover this. So I don't think bankruptcy is a risk for this company. Let's go see how much cash they have on hand. So it's easier always just do a summary view here, and it looks like that they don't have any cash on hand. They never have cash on hand, not since 2018. They tend to spend everything they get. They're not exactly Microsoft and Google, let's put it that way. So this company does come with its risk. They don't manage their money particularly well. It doesn't, at least not on the surface. So let's have a look at what the bulls and bears have to say about Cheniere. The bulls say that at $500 to $600 a ton for incremental capacity expansion, Cheniere has some of the lowest cost LNG projects on the global cost curve, well below the US average of $800 a ton, and similar targets by Australian LNG producers. So they're a cheaper LNG exporter than the average US LNG exporter, and they're similar to the Australian LNG producers. So that's good. So they're cost effective. And that might be another reason why their stock price kind of trades at a premium. Cheniere's contracts are very strong with no price reopeners, no linkage to oil prices, and flexibility on delivery points. Cheniere should have billions of dollars to deploy over the next few years towards stock repurchases. That's great. Dividends or distributions on further LNG projects. The bears say if China changes its government policy on higher natural gas consumption, this would likely mean a decline in demand for U.S. liquefied natural gas. The complexity of the Cheniere group of entities can be difficult to understand. So we can try, but apparently it's difficult to understand them. And the U.S. gas supply is not the lowest cost global gas available at $3.30 per million cubic, and I don't know what F would stand for. But in any case, whatever it is, it's twice that of Qatar, which comes at $1.50 per MCF. Though because U.S. gas costs are more variable than stranded offshore projects, U.S. gas supply is likely to be the marginal supplier of global gas. So even though we're a little bit more expensive, it's looking like we're still gonna be a supplier of global natural gas. So those are the bull and bear cases for Cheniere. Let's have a look at the financials for Energy Transfer Corporation. Energy Transfer's ticker symbol is ET. Now this one is down 9 cents today. It's currently trading at $10.97 a share. Its second quarter earnings are expected on the 2nd of August. They don't give an equity rating by Schwab. Over the past year, it's down 2.92%. Over year to date, it is up 33.9%. It's got a price to earnings ratio of 10.4, a forward PE of 7.8, so it's expected to grow. It has a very nice dividend yield of 7.23%. It's got the same problem that Cheniere has, although it looks like markedly worse here. It's got the market cap of $34 billion. However, they've got an enterprise value of $97 billion, indicating that they have a lot of debt or no cash at all, but probably they also carry a lot of debt. This might be an industry standard to just carry a ton of debt. It looks like their dividend is paid out quarterly, and again, it's 7.23%. So let's have a closer look at their financials. All right, so right off the bat, you can see that Energy Transfer Corporation is a much larger company than Cheniere. They were 40 billion in revenue as opposed to 15 billion. That was the most current year in Cheniere. So from 40 billion to 54, 54 to 54, and then it shrank to 38, but then it went up dramatically to 67 billion this year. Their cost of operating is 58 billion. So it looks like their margins are roughly, let's see, about 10% margins-ish. Let's have a look at that debt of theirs. So their total assets are, let's see, 105 billion. Their total liabilities is 74 billion. So their book value is greater than one. So that's favorable. Their total debt's what we really care about. And how much of that is long-term debt? It appears that, wow, it appears that it's almost all long-term debt, same as Cheniere. Their total current liabilities they owe to others is $1 billion. They clearly make enough to cover that. So that's not a problem. Their cash flow statement, let me see if they're cash flow positive. And if they're anything like Cheniere, they will not be, and they are not, but they're not as bad as Cheniere. They actually look to be more sound. I don't know why their stock is so cheap, but we'll have a look at this and figure this out. So we're going to look at the Morningstar report for Energy Transfer Corporation, because there's got to be a reason why this company trades at $10.95. So Energy Transfer by Morningstar, its current price is, its last price, at least at the time of this print, was $10.83. They have a fair value estimate of $17.50 and a 5-star rating on Energy Transfer. So right away, it's looking like a pretty promising company. Its capital allocation is poor. Okay, that goes without saying. I mean, they do have a much higher enterprise value than market cap. First quarter market conditions have generally played directly into Energy Transfer strengths around optimization and marketing activities during times of oil and gas price volatility. So yeah, so we know oil and gas is going up, so that they're benefiting from that. The bulls say Energy Transfer's consolidation in October 2018 reduced the company's cost of capital and helped fund its growth projects over the last few years. So this company is trying to get better with money. So it looks like in some degrees or some areas, they managed to consolidate their footprint in order to grow other projects that are more meaningful to this company in the long term. They're well diversified across markets, commodities, and geographies, giving the company access to many large customers. Energy Transfer is well positioned to benefit from our outlook for growing natural gas liquid export. So they're well positioned to export, and they're using their money better and more strategically. Now the bears say a long-running legal battle threatens to halt operations on the Dakota Access Pipeline. Okay, there would probably be your reason for the cheap stock price, demonstrating the substantial legal and regulatory risk Energy Transfer faces. Energy Transfer has historically been active in the merger and acquisition market, exposing the firm to the risk of overpaying for growth and enable transaction demonstration. So they're kind of like a Salesforce in that way, that they just buy things. So, but I'm thinking that maybe that's part of the consolidation thing, and then being able to grow in a way that is more favorable to them. Rising interest rates could make Energy Transfer's distribution less attractive as a fixed income alternative and raise the company's cost of capital. So they have to borrow a lot of money, and so it's going to cost more for them to spend money. But let's have a look at what this legal battle thing is, because that tends to be the problem here. Okay, the Dakota Access Pipeline, one of Energy Transfer's largest assets, remains under legal and regulatory attack. If the pipeline ultimately must shut down, it would have a material impact on earnings and cash flow. All right, well, there you go. That's your reason why this company is priced under $11 a share. However, it'd be something to keep an eye on. So maybe that you could invest in this, provided you keep an eye on that. In the meantime, you do collect a pretty nice dividend. And they are pretty much sure to export more liquefied natural gas this winter than they generally would. So all these things are kind of positive for this company. But that is definitely something to be concerned with and keep an eye on if you're going to invest in Energy Transfer Corp. So yeah, so those are a couple ideas for liquefied natural gas plays. You know, they're not typically the sort of thing I would get into. They are a good deal. I kind of like Energy Transfer a little bit more for the dividend. But the reason why I don't get into them is because they don't have much cash laying around, and they have a whole lot of debt. And those are the things that I try to steer away from. That's why I like companies like Microsoft and Apple and Amazon and Google. And those are the companies I tend to gravitate towards, because they're the ones with all the money, and they're the ones that are going to be able to steer through a recession and through high interest rate times. They're just not going to have to borrow that much, and they're not going to have to pay those interest rates, really. All right, so let's go ahead and we'll take a quick look at a video from Tony Dwyer. He's that chief market strategist from Genuity, and he has a take on what historically is a market bottom. So we'll have a quick look at this video, and then when we're done, we'll calculate and see where that would actually put the S&P according to his data.
You're not going to get probably a market bottom until the Fed turns.
Well, the Fed's got a signal a turn. They in 1994 they raised rates even into early 95, but the market had already turned because they had signaled the end. That's the opposite day here.
I want to ask you about some of the positive things for market. All we've done is talk negative.
For sure.
Positioning is awful. If you look at the professional community, positioning is also very, very conservative. In other words, there's a lot of exposure that's been taken off the table. You've got corporate buybacks almost at a record pace. I mean, at some point, these are factors that say the market actually has priced in a lot of pain. We've priced in probably 90% recession at this point.
Timmy, I got to say, so let's put the numbers to it. The data that I have is when core inflation is above 4%, market trades at 13 times earnings. When core PCE is between 3 and 4%, it's 16 times. When core PCE is between 1 and 3, it's 20. 19 and a half to 20. So we're around that. I would expect that it's going to peak and come down by year end. So you'll be in that 3 to 4% area. So you can do a 16 multiple. And ultimately it comes down to the E side. I've been below the street all year. I love the game that we're in where we raise targets and estimates as it's going up and then do the reverse when it's coming down. I've been at 225 since last year. I don't see any reason to really change it. The street's at 229. It still has to come down, Timmy.
All right. So Tony Dwyer, he said that if the core inflation is over 4%, that the S&P will trade at about 13 times. And if it's between 3 and 4%, he says that 16 and a half times is pretty reasonable, and anything under than 3%, about 19 and a half to 20 times. He also said that his price per share, if you will, for the S&P 500 was $225. That was his target. So when you punch in $225 and you multiply that times 13, now we're saying that we think that the core inflation is going to be over 4% at the end of this year. And that seems kind of likely considering it's sitting at 8.6 and going up. We're showing that the S&P would be right around 2,900. So that's really low considering it's sitting right now at 3,700. However, if it trades at 16.5 times, because he says he thinks it'll be between 3 and 4%, and you multiply that by 225, that gets you to 37.12, which is almost identical to where it is right now. That's why he's saying that the current price is just fine. We wouldn't expect it to go up much by the end of the year, but we don't really expect it to go down much by the end of the year. And should it go lower than 3%, I think it was, yeah. If it goes lower than 3%, then we get the 19 and a half times, and that'll send us to the moon. Well, not really. That'll send us to 43.87, which is still not as high as it started this year. And this is all dependent on whether or not earnings stay elevated. But, earnings have been going up 10%. At least the guide is up 10% on the S&P this last year versus this year. And we're also getting a lot, like historically high numbers of stock buyback because these companies are making money, as evidenced by Oracle today. Oracle puts out these numbers today, and they beat their top and bottom line estimates. And, of course, the stock is soaring today. And a lot of people like to say, well, that's a canary in the coal mine when something's bad, but maybe this is the canary in the coal mine. Maybe tech is not doing as bad as people say. I tend to think that tech is it's where I'm putting my money, because I think of tech as being a bigger staple anymore than say Coca-Cola or McDonald's, which is a traditional staple. I think of a newer staple would be like Microsoft and Google. These are things that we can't live without. Amazon would be another one I can't personally live without. I mean, my Amazon guy, he should show up in a Santa suit because sometimes I'll order something, I forget what it is, and I get there, I'm like, wow, it's just what I wanted. But yeah, Amazon for me is a staple, and Microsoft and Google. Apple's kind of a staple, but there are alternatives to that, but there's really no alternative for Microsoft. Later on in this video, John Najarian chimes up about the state of the economy and stuff like that. I think that's really interesting. And I really like John Najarian because he and I noticed that when I listen to him speak, he and I trade very similar. We're always out trying to get that little extra bit of money. Where are we going to find the next little bit of money? And he's a guy that does this. And I do the same thing. And I'll tell you where I'm getting money here, like right now, how I plan to get some money this week. And I'll show you how I did last week.
You know, Pete, can you help square that? Because I think what Tony and everybody's making is a really important point for our audience. I was down your neck of the woods this weekend in Sarasota. Flights were packed, airports packed, hotels packed, restaurants packed. And yet we're talking about economy slowing down. We're talking about consumers going out. But what you see with your own eyes and what these numbers are saying, they do not link up at all.
No, you're exactly right. They certainly don't. But I think, Brian, I think the real case is, are these people that are going on their one opportunity to go travel, matter of fact, to go to Florida or whatever it is, are they going to be able to do that again? Probably not. We all know how expensive gasoline is as far as driving around as well. People are willing to make that trip, but those are sacrifices that takes money away from other parts. So yes, that looks really great when we see as busy as they are, but there are other elements that go into it. They can't spend over here because they've already spent over there.
So just like they said, is that people might not be spending as much money traveling. And I'm a little bit bearish when it comes to traveling at the moment, because I myself was going to go on another short vacation in July, but I've canceled it. And the reason why I canceled it was because of these airline prices. I've never quite seen them this way before. And granted, this was over the July 4th holiday, but these prices did seem very elevated. I was going to go from Philadelphia to Spokane. And a reasonable ticket, you know, an 8-hour flight would be $1,400. If I want to spend 17 hours traveling, that would have been $1,886 or $886. This here flight would have me leaving on a Monday and coming back early Tuesday morning, or excuse me, leaving on a Tuesday and coming back early Wednesday morning. I guess if you want to call 12:36 a.m. Wednesday, But a reasonable flight of about 8 or 6 hours would be about $1,500. And I was going to have to buy 2 of these tickets. And this was a flight to Spokane. So this was just not something I was willing to do. So I'm going to pass on this vacation, and I'm going to get another staycation, which is actually my favorite. Maybe I'll take in another Phillies game. We'll see. So just based on my own life, I'm a little bit bearish on travel right now too. So I don't eat out a whole lot. I own a Tesla now, so I'm not paying gasoline prices. I'm not going to be spending $1,500 a ticket to go somewhere. And I think this is where a lot of the American consumer is going to go to. We're not going to travel as much. We're going to, now that EVs, the price point has become more attractive. Volkswagen has the e-Golf. You can get that for less than $20,000. They've also got the ID4 brand news. You can get those for less than $45,000, which used to be an expensive car, but anymore is pretty reasonably priced. Polestar is out there at $55,000, and used Tesla's Model 3s are in the low $40,000 range. So the barrier to entry is coming down on a lot of these EVs. And so I picture that a lot more people are going to switch to those. You know, a lot of people are going to buy a car and just like, well, might as well just go ahead and get an EV. And a lot of people aren't going to travel, and a lot of people aren't going to sell their house they're in, because now interest rates are up over 6%. And that's before tomorrow. They're about to hike interest rates even more tomorrow morning, and we're looking like 75 basis points is the odds-on favorite to win. So the interest rate might get close to 7% by the end of this week or next week. We'll see. So these are all things that, you know, it seems that I can usually tell where this market is going just based on my own life. That's very much a Peter Lynch sort of thing. Like Peter Lynch would decide what stocks he should buy based on the things that he liked. He bought Dunkin' Donuts because he liked Dunkin' Donuts. They were down the street. They were popping up everywhere. He bought Dunkin' Donuts. Sometimes it worked for him. Sometimes he doesn't. But he says, look in your own backyard for your best deals. And for me, my best backyard is my own life. I'm not traveling. I'm buying an EV. So, and I'm not selling my house. So these are all things that are my backyard. And at the end of this year, I'm going to have to do some tax loss harvesting. So I imagine a lot of people are going to do that this year. Look out at the end of December, unless the Fed comes out and really lowers rates, which I doubt they're going to do. Maybe they will. But they don't have to lower the rates. They just have to project that they're going to lower the rates. That's what, you know, as what Tony Dwyer said in that video. Now, the very short video coming up from Joe Moglia, I'm just going to just for a second here. And let's just see what he has to say about the retail investor.
So the Netflixes come back. What about the retail investors? Because these are new investors, relatively new, younger investors. You get burned that badly, and that was what happened after the .com. I mean, you know the retail world so well.
But as time went on, investors got back involved with the market. So the day trader were the ones that got killed. The individual investors, again, probably don't have big positions in something like Bitcoin, but they're involved with the market. Now, if I'm an individual investor, we all know this, right? You've got to have a disciplined, well thought out strategy. You can't ever panic. And one of the things I think, frankly, we should talk more about on your show is the idea for an individual investor, dollar cost averaging is by far the best way to be able to deploy capital. And if they've been doing that all along, they're putting money in the market now when it's low, and they were putting in money while it was going up. But that's the best way, I think, to be able to do that. They shouldn't be calling ups and downs.
So yeah, so Joe Moglia, he talked about how it just doesn't make a ton of sense to sell right now. It makes more sense to dollar cost average into your positions. He says, and I kind of agree with him, that I hate to be the bearer of bad news, but the time to sell is not now. The time to sell was, about 6 or 8 months ago. And so you missed it. And so did I. And so right now is just go ahead and just try and find little ways to make money. And I'll show you how I'm doing it. And it just doesn't make a lot of sense to sell right now. This is really just the time to consider buying. So let's see how I've been doing, and let's see what my plan is just going for this week. So my realized gains has not changed. It's about $956. Last week I made $188. I was on vacation, didn't have a chance to look over things. But one of the things that I was really wrong about last week was that I thought when the FOMC minutes came out on Friday, that I thought that the risk was to the upside. I thought that we'd already kind of bottomed out to some degree, and that when they would do the FOMC minutes, we would either fall a little or go up a lot. But it did not turn out to be the case. Not only did we fall a lot that day, we fall a lot the next day, and I think we might be falling today too, although I'm having an okay day. Yeah, we're down about 263 on the Dow. We're falling a little bit today, but not too bad. So last week I ended up making about $48 selling a put on 5 below, and then I made some money on covered calls on AMD, JP Morgan, Lowe's, and UPS. This week so far, I've not made too many plays, but one of the plays I did make was on Adobe. They're set to release earnings on, looks like Thursday, and it's going to happen after close. So I went ahead and sold a put on Adobe. And so on Adobe, I've only got the 2 options that are open now. I'm expecting that tomorrow after the FOMC releases their minutes, that I would expect the market to bounce a little bit. It's like, oh, okay, you said 75 basis points, and then it's going to go up a lot, and then I'll sell a whole bunch of covered calls that I'll probably make expire not this Friday, but the following Friday, not the 17th, but the 24th. And so right here on just a quick buck to support my baseball habit, looks like I've done it for Adobe with an expiration date of this Friday, and a strike price of $305, and someone paid me $114 to hold that contract. I'm currently up just like $7. I'm basically broke even so far. And then on UPS, because it's always just seems to be up. When a stock is up is when I'll sell a covered call. I'll never sell a covered call when the stock is down. When the stock is down is when I sell puts. When the stock is up, I'll sell covered calls. And so the covered call would be a short position, and it looks like I'm short UPS. If it finishes below 182.50 on Friday, I'll get to collect $58. I'm kind of close to where I just cash it out now. I probably should cash it out by the end of the day. They got a bump on the FedEx board of directors changes that they got today, and so they got a boost probably as a result of being part of any ETF that FedEx is a part of. But they're doing all right today, it looks like. And I'll probably close them out and then wait for hopefully a huge bump tomorrow, and then I'll resell it again tomorrow. Through this time, my strategy is just like small, like little market gains. And then I told you that earlier that I plan on at the end of the year doing some tax loss harvesting. I mean, if this was the end of the year, I think I can tax loss harvest up to $3,000. And when I look at my realized gains and losses for the year, what I'll end up doing here at the end of this year, is just, and I haven't made a ton of money this year, but it's better than losing. It looks like this year I've made so far about $8,100 in options, and this is at like, $25, $30 at a time. A lot of these I lose big sometimes, but by and large, I just nickel and dime this thing to the tune of over $8,000. And I'll just continue doing this through December. But come December, I would imagine this number will be closer to like 11,000. And then what I'll do is I'll be danged if I'm going to pay $11,000, capital gains tax on $11,000 on a year like this. So I'm actually going to sell probably about $14,000 worth of losses. And not only am I going to not have any capital gains, but I'll be able to write off about $3,000 in losses. And that's the way I'm going to do this. And then with that money, I'll have some extra cash that I can reposition into new positions in my portfolio. And that's what I plan on doing here at the end of this year. So one way that hedge funds are trying to make a little bit of money now is by buying puts on these ETFs that sell high yield corporate bonds. And they're high yield corporate bonds because the holdings, the companies in these holdings are of the junk grade. They're not investment grade bonds. These are junk grade bonds. But for that, you get a higher yield. Like this one yields 6.5%. This one here, the clues in the name here, it's J and K, so it's junk. This would be the Spider High Yield Bond ETF. Their return is 6.97% paid out monthly, but again, it's because it's a risk. It's down 17% year over year. This one's down 16% year to date. And people think that with these high yield corporate bonds that they're going to default on them because of rising interest rates. So let's look at some of the holdings they have, some of the companies that they have that are part of this junk bond ETF. Some such as Carnival Cruise Lines, we know they're in trouble. American Airlines, we know they're in trouble. Carvana, I didn't realize they were in trouble, but apparently they are in a little bit of trouble. So this would actually be a good list of companies to take a look at that you maybe don't want to invest in at this time. Like right now, if you're going to invest in stuff and then you're actually going to take the advice of Joe Moglia over there at TD Ameritrade, want to make sure that you're investing in companies that can actually pay their debts, that they're companies that have a lot of money. And I know I keep pounding the table on that, but this is not the time to go investing in profitless companies. All right, well, that's going to do it for today. If you got anything on this video, please like, subscribe, hit that little notification bell. And even if you didn't like it and subscribe it and hit that little notification bell. Until then, we'll see you next time. Bye.
Nice.